Hello, everyone. Welcome to Real Estate Right Now, where we talk about real estate matters that matter to you. My name's Jay Izzo, and we are live here from Lindencraft Team Studios here in Raleigh, North Carolina, part of the Greater Research Triangle Park. Today's show, what's going on with mortgages? Seriously, I mean, we've got so many weird things happening. We've got some stats that have come out, and then it's every week is a different thing with mortgages. Every week, it's like something different is happening. Something's in the news. Something's happening with the rates. Something's happening with, we see more people trying to apply for mortgages, and then we have a week where they're not applying for more mortgages. It is all just kind of all over the place, and we need answers. Is what we need. And
you open this show with a loaded question. What is going on with mortgages?
What is going on with
what is going on?
Well, and this is why we bring Paul Fitz, Senior Lending Officer from Advantage Lending, back with us, because I feel if anyone can add more confusion,
I'm good at this.
Paul, no, he's going to help clear this up. Hopefully, if not, what we're going to do is we're going to be asking more questions, because there is a lot of fog and there's a lot of subjective things might happen that we don't know might happen.
Fake news.
It could be. Yeah, I mean, we don't know. Well, it's interesting because when we talk about mortgages and when we see stuff in the news, because it changes every week,
every day.
Yeah. But how when I do my research for the show, right?
Yeah.
It's a weekly thing.
Yeah.
Where it's like where I get weekly, updates.
Weekly updates, yeah.
Yeah, and then one week, mortgage applications are up. According to your industry this past week, in fact, they said up 6%.
6%.
6% up, highest number since 2022. And then we get, and
we wonder why.
And we're going, why? And then we've got like, is this a good, well, should I be in market then? Is this a good time to buy a house? Is this a good time for me to sell a house? Can I get a good rate? What's that? I got people talking about ARMs. I've got people talking about 50-year mortgages.
Oh no!
And so now we're kind of like going, okay, so what's going on with? And then
on top of it,
you said this repeatedly on the show that when the Fed lowers the rate, the housing interest rate goes up.
Mortgage rates go up.
Mortgage rates go up. You've said this all the time.
Ad nauseum.
Yeah. And people still, for whatever reason, are skeptical.
I heard they lowered the rates.
I heard they lowered the rates.
Lowered rates.
But the mortgage rate didn't go down.
But I heard they lowered rates.
I know.
I heard it.
And this is the thing. Yeah. This is the thing, is that you said it over and over again. But people go, okay, well, and then of course we use words like, well, it's baked in, or ish, right? Yeah. Something's baked in or not.
We anticipate.
Which, by the way, I don't think people really understand when you go, what do you mean it's baked in? I mean, we've had your colleagues in here talk about baked in rates.
Yeah,
the rates have already been baked in.
Right.
So
you've seen me bring in charts. 200 years of interest rate charts.
Yep.
We've seen the whole thing.
We've seen the whole thing.
Yep.
I still think there is a little bit of dare I say this word, disillusionment that
amongst the general populace,
amongst the general public that believes, well, I'm just waiting for it to get back to 3.
Good luck.
Yeah, because I mean, we showed that was a historic
80-year low. 80-year low.
Right. I mean, it's kind of like a floodplain, 100-year floodplain.
Right. You don't expect that flood to hit for another 80 years, whatever.
But it's a 100-year floodplain type thing where it's kind of like, okay, this happened, but it may not happen for another 100 years.
I think the conflated word that everybody likes to use in this instance is affordability.
Sure.
I think that's the conflated word.
Sure.
How do we make these things more affordable?
Mm-hmm.
How do we make housing? How do we make our living? How do we make our monthly mortgage payments more affordable?
Right.
I mean, how do you navigate that in a time where housing prices are, at this moment, they're kind of stagnant, right? Maybe even decreased a little bit. Right. And
at least in our area, resales in particular.
A little bit.
Yeah.
Right. But overall, over the last 40 years of housing, it's done nothing but really go
up.
It's an up escalator.
Yes, absolutely.
Right? Okay. So everybody's like, well, how do I navigate this? How do I make things more affordable?
Right.
One of the things you just mentioned, and I've heard podcasts and people talk about this in the last few days, talking about the 50-year mortgage. It's gonna make things more affordable.
Okay. Let's start right there before we get into anything. So, rumor mill. I'm not going to say it's factual because there's nobody.
I haven't seen one yet.
Nobody's seen one
I
yet.
haven't seen
right?
one yet. Yeah.
So it's a little bit of an albatross that that's out there. That there has been talk of a 50-year mortgage. I've even seen it phrased, the return of the 50-year mortgage. I didn't even know if it
existed. It existed prior to my ever entering.
Prior to you and I ever being born, probably could have existed.
Yeah.
The 50-year mortgage. So first of all, let's be clear. Nobody has a 50-year mortgage that they're offering on the table
that I've seen.
Right.
I mean, I'm not saying it doesn't exist. There might be some outlier banks that might already have it in place, but I haven't.
But it's really been more talk.
Yeah.
But let's talk about the reality of the 50-year mortgage.
Sure.
Okay, because
as far as affordability,
as far as affordability is concerned, because I've done some statistics. I shared with you some of the stats that I said, and by the way, which agreed with your stats.
Yeah.
And we did the calculations, right?
Crunch the numbers,
right? 50-year mortgage, does it really make the house more affordable? And how much money are you really saving?
So I did a comparison of a $400,000 loan amount, not purchase price, just the loan amount itself is $400,000. And I didn't add taxes and insurance. I was just doing principal and interest numbers only.
Right.
So principal and interest payment over a 30-year period of time. And again, I can't remember the number right off the top of my head, but let's just call it $1,800. Let's say the number was $1,800 over a 30-year period of time. The same $400,000 amortized over a 50-year period of time was $1,600 a month.
Right.
So in the numbers that I kept running in other scenarios, it's about a $200 a month savings.
Right.
If your finances are so out of whack that $200 makes the difference in buying a house, you're probably buying out of your price range anyway.
Right.
So do I view a 50-year mortgage as a tool? I view it as a tool.
Right.
But let me tell the populace and the public at large, interest-only loans were a tool. Negative AM loans were a tool.
Right.
The 2-year, what do we call them? The subprime mortgages, the BC lending, they were all tools. The problem is when you talk about these tools to the public at large, again, they're like, this is a way that I can afford it, blah, 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 blah.
Right.
No, man, my job as a lender.
Sure.
My job as a lender is the same as a doctor. I need to diagnose the patient and try to prescribe that patient to be in whatever product that best suits them so they can also not only buy the house, but afford the house and keep the house. $200 in somebody's market means a 1-year increase in taxes. That is significant for people. My taxes last year went from $4,800 to $6,000, right? So me telling you that it's the inevitability of something going wrong with that 50-year mortgage and selling it to the wrong people because it's a tool. It is a tool, but it doesn't mean it's for everybody.
Right.
And how much principal does that pay down?
Well, this is the thing, because the scenario I worked, I think I talked to you about, was on $500,000.
Right.
And I think the savings was $233 a month on $500,000.
Correct.
For between a 30 fixed and a 50 fixed.
Yep, 30 and 50.
Conventional.
Yep.
All right. So it's $233 on a $500,000 loan.
Right.
So the question then, that I pitched at you when we were talking about this off air was, okay, maybe it can get you in the door. Maybe it can.
Yeah, it's a tool.
Maybe it can get you in the door.
It's a tool.
But when we think about equity and building, having some money, because
when you sell the house,
the amount of interest, because let's think through this.
You're just paying interest.
Because on a 30-year fix,
Right. You're not paying much interest or principal to start with.
Right?
Yeah, right.
But you get there faster.
A whole lot faster.
You're adding 20 years to a 30.
240 more payments.
240 more payments. Yeah. How much principal are you paying? Pennies?
Pennies on. Yeah, you're not paying any principal at all. It's basically an interest-only loan. And it's not
right.
It's not a significant interest-only loan.
Right.
Unless they were going to give a interest rate deduction for doing the 50-year,
right,
then it might make sense for somebody at that point.
Right. Right.
But they're not going to do that. They're going to increase the interest rate on a 50-year loan versus a 30-year loan anyway.
Yeah. And
same as a 15 or 30 now. 15-year loan has a lower interest rate than a 30-year has.
So, right. So but let's think about this for a second. If the average person moves typically somewhere between 4 and 5 years, about 4.2, 4.5 years.
4.5.
4.5 years. Let's just put it right there. Yeah. Let's say the average person moves to houses. In 4.5 years on a 50-year mortgage, how much principal did you pay?
Hardly anything. Yeah, hardly anything.
Okay.
You're praying, you're hoping and praying. By the way, I've said this in different aspects of life, but hope is not a plan.
Right.
You know, if you're hoping that your house is going to increase in value over that 4 to 5 year period of time, you might be in a stagnant period of time where house prices are not increasing like they did from 2000 to 2000 and, or I'm sorry, from 2020 or 2017, really, from 2017 to 2022, that was some significant house price increases.
Sure.
Right.
Sure.
People were moving into the area fast and furious.
Right.
Bid wars, blah, blah, blah. If you're hoping that's going to happen again, hope is not a plan.
Right.
Right.
Yeah.
You need to understand the totality of your finances. Now, I understand the reason why people are talking about it so much.
Right.
It's to create buzz. It's to say, hey, there's this new way I can save money and still buy a house. I get it. I believe in marketing.
Sure.
Just as much as anybody else.
Sure.
But I'm also responsible enough to still tell people that I remember the periods of time where we were doing interest-only loans and option arm loans for people to get them in the door because they said, oh, yeah, I'll refinance and it'll be a 30-year, blah, blah, blah. And then the mortgage crisis hit.
Right. Right.
So are the two things the exact same? No. But are people coming at it from the exact same perspective? Yes.
Yeah.
And that's the problem.
Yeah. I think to put this to rest on the 50-year mortgage, first of all, nobody's got one. It's not out. And if it, at least as far as we can tell anywhere, it's still talk.
Right.
2, not as big of a thing as people want to believe. And while it may get you in the door from a long-term wealth building perspective, probably not helping you a whole bunch outside of just getting you in the door somewhat.
Get you in the door.
Okay. Let's move to the other topic that came out. The Mortgage Association came out this past week, and said that mortgage applications were up 6%.
Yeah.
All right.
Year over year, or 2 years.
Since 2022, highest since 2022 was the quote. So that has my interest peaked because I'm wanting to go, why would we see such a peak in mortgage applications in November, the first week in November? Why would that occur?
Why would it occur?
Yeah.
It could, honestly, it could be anything. It could be people finally saying, you know what, I feel like I'm in a stable economic position now that I don't want to rent anymore. I feel like I can buy now. Some people want to conflate that with, oh, well, I heard the Fed lowered rates.
Yeah, we'll get to that.
Okay. Yeah. Well, there's a conflation as to why.
Right.
I will tell you that I personally have done quite a few refinances lately for people who, bought in 2022, 2023, when interest rates were 7.75 or 8.5. By the way, August of 2023, interest rates got up to 8.5%. 8.5% was the highest interest rate spike we'd seen in 40 years. And people were still purchasing homes, obviously not as fast and furious as we've seen in the last decade, but it could be a combination of, hey, the market has decreased enough to where I can save some money on my monthly payment. They may have said, hey, I'm going to wait till the Fed lowers rates.
Right.
And then they call their mortgage lender guy. The guy's like, yeah, you should have called me in September because rates were lower then. And they're like, you know what? I need to save money anyway.
Right.
I will say that this time of year, always November, December, January, it's our slowest time.
Right.
This is always our slowest time. I think that there are people out there who have seen houses on the market for 90 days, 120 days, 150 days. And now they're saying, you know what? Nobody's moving on it. I think I can
Get a deal.
move on this property and get a deal.
Yeah, get a deal.
And I'm seeing it over and over again now. I'm seeing larger seller concessions, and I'm seeing a larger, price reduction.
Well, and we've seen that across the board because even though it's not talked about in the new homes industry, we are seeing, builders offer
massive incentives because they don't want to lower their price.
Because they don't want to lower the price. Right. So we get massive incentives on that. And so the prices still look the same.
It's still $450,
right?
But we're giving you 20 grand
or more.
Yeah, exactly.
I mean, more. I mean, $30,000-$40,000 depending on, right, or more.
Yeah, come buy our house.
Come buy our house. So
you got to move it off the books.
Right. So it's kind of a misnomer of what we're seeing here. Yeah. I also wonder, and this is something I wanted to throw at you. We have not talked about it. So,
great.
But could some of this 6% jump, and it's not a huge jump, let's not get crazy here, but it's significant.
There's
but
enough to
tip the scale.
Yeah.
Could some of this start to be that people go, you know what? I'm finally habituating to the rates. Meaning that reality is I'm not going to see 3. And right? I mean, because you're not. But maybe they're finally getting to the point because we're getting further past the pandemic where people are going, it's going to be what it's going to be. Yeah. And I need to just get in.
Right.
And I kind of wonder if they're finally starting, if we're starting to see the consumer finally start to make the adjustment to go in their brain, because it's a little bit of an adjustment emotionally to say, yeah, this is probably not going to happen, but I need to get in.
Right. Accepting reality.
Yeah, right.
Is probably about the best way to say it.
Yeah.
They're finally, well, I don't think they're ever going to go down further than X or further than Y. And again, bringing the 200-year chart,
right,
talking about the normalcy of rates, right? So if you look at the 200-year interest rate chart for the United States on 30-year fixed mortgage, remember, the majority of time in our country, rates have been at 6 or below, meaning that if you take 200 years, 100 of those years, they were at 6 and below, the other times, or whatever, right? But the majority of that time, they were at 5 and below. So it's kind of accepting where our reality really should be. So meaning that interest rates should probably be at a normal of a 5, 5.5.
Right.
Maybe even a little bit lower sometimes, depending on how good the economy looks.
Right.
That being said, I think people are saying, hey, you know what? Fence sitting is not doing me any good.
Sure.
I've been sitting on this fence for a long time. My butt hurts from sitting on this fence. Right. Time to hop off.
Right.
Let me go ahead and accept the pain of what reality is. And I think moving forward, I think they'll accept this as a normalized market.
Well, there's something, and by the way, shout out to Bob Winstead, who's out there watching. Appreciate you tuning in, as we do everybody who's tuning in right now, that I can see, giving us some loves and likes. I go back to when Linda started her business in 1985. Interest rates were around 16 to 18%.
Yeah.
Right.
That's the worst time to start, right?
I came into the business in the 90s, the mid to late 90s, right? And we were about 7.5% to 7 to 7.5%.
I got in 99 and rates were about 8%.
Right. So, but when we saw 7%, and this is how comparison works.
Yeah.
Right. You came out of a market that was 16.8%. You see 7.5%. You're going, oh my gosh.
Yeah.
This is free money.
Whose ring do I need to get?
Yeah, this is free money.
This rate.
This is free money. Yeah. But then when you go from a 3% to a 7%, you're going, "Man, I'm getting gouged."
Yeah.
But the reality is,
Right.
there's a reality here. It probably is where it's supposed to be.
And think about how the pendulum has swung to go that high in
Right.
interest rate to that low in interest rate.
Right.
But it took 40 years to get there.
Right. That's the point.
It took 40 years from the
Right.
16 to get it down to the 2.
Right.
Yeah.
So, I mean, I think there is whatever section of life that you live in, right?
Yeah.
If you were living in that 80s and you got to the 90s and you saw 7%,
Oh yeah,
you were refinancing like crazy.
When I got into the business, it was a refi boom,
market,
and I did not realize it.
Right.
I didn't even understand that because I
Right.
was new in the business.
Right.
I'm just helping people buy houses. Then people call me, "Hey, by the way, blah blah blah." I'm like, "Yeah, I guess they are lower. Maybe I should help you out."
Yeah, right. And it was a big deal. And that was when you were with the C letter company.
CTX.
Yeah.
It
Okay.
doesn't exist
It
anymore.
doesn't exist. Oh, that's right. They don't exist.
They don't exist anymore.
They don't exist anymore. But I think that comparison has hurt a little bit and maybe pushed people back. And I think we're starting to get used to that. That's kind of my
in
opinion.
the age of TikTok and 2-second videos. And,
Yeah.
I mean, the attention span of humans, no offense to humans, obviously,
Right.
but the attention
We are
span,
human. Yeah.
is a TikTok video.
Right.
So they're comparing this week to last week.
Yeah. Right.
They're not comparing, this to the 1980s.
Right.
And granted, houses in the 80s were selling for $150,000.
Right.
$200,000
Right.
for a nice house.
But we weren't making as much money then
Right.
either.
Correct. Again, like I'm saying,
Everything's relative.
right. And people are conflating. They're always conflating.
Right.
They're like, well, why isn't it this rate or why isn't it that rate?
Right.
Why can I not afford? I'll tell you a big problem with affordability: student debt.
Sure.
You should see me pull a credit report on somebody with $100,000 of student debt.
Absolutely.
And then I ask them what they do for a living. Oh, well, I'm an admin assistant at blah, blah, blah. Like, you're never going to pay this debt off.
Right.
Like, there have been so many things to counteract what affordability is. And yet the first thing a student does when they graduate and they get out of college, the first thing they do is go buy a car. Right. And so not only do they have $100,000 of student debt, now they have an $800 car payment.
Right.
And now they're wondering, why can't I afford a house? You didn't talk to me before you go to college.
Right.
There's a reason why you can't afford a house.
Right. Right.
But I have to figure out a way to get you into a $400,000 house because that's all that you can find in this area now.
Yeah.
You don't want to count all these other factors into play. It all plays into affordability.
Speaking of the interest rate.
Yes.
That
went up.
Which did go up. I'm not going to get to that quite yet.
Okay.
I just want to kind of talk about, though, because we did bring it up, about a good time to buy.
Yeah, always.
I have been a proponent of this, that, first of all, I think depending on your circumstances, any time could be a good time to buy.
Correct. That's right.
But I have always said this time of year, when it's slow, when there's little competition,
right,
when there's fewer people looking at the same house,
bargains to be had,
that people want to get out before the end of the year.
Yeah.
And you've got people who are trying to either get out or get in.
Yep.
They're very serious.
Yeah.
Typically. This is really a really good time.
This is the best time to buy because there's less people in the market looking right now.
Right.
There's still the same amount of inventory, this month as there was last month.
Maybe a little more.
Yeah, correct. Now I know everybody, thinks about the holidays, and you're thinking, right, I got to get to grandma's because
right,
Thanksgiving
over
is right
the river through the woods.
That's right.
Yes.
The whole Charlie Brown thing.
Yes, I know.
Right.
Yeah, right.
You're thinking about Christmas. You're thinking about Hanukkah. You're thinking about any kind of. You're thinking about any kind of normal holidays that you celebrate with your family. That's on your mind. Right. But the truth is, there are for sale signs everywhere.
Everywhere.
And while you're driving over to grandma's house, what does it hurt to stop by and pick up a flyer and see what that house is?
I am just saying, we have seen in the real estate industry, over the last couple months, for sure, and continuing, price reduction after price reduction after price reduction.
Yeah.
I think there was an article put out, I think it was by NAR. I may be wrong, so don't quote me on my resource here, but that one of the highest numbers of price reductions across the
during
country.
this period of time.
Yeah, for the last couple months,
Yeah.
because there's just been so much more
Too
inventory
much more inventory. Yeah.
and they're saying that it, goes, pre-pandemic levels
Yep.
of inventory right now. So we are seeing price reductions. People either need to get out of their house,
Right.
or they so desperately they're contingent because they want to get to this other house.
Right.
And so there is just a golden opportunity.
There's transitional situations everywhere.
Everywhere. that can get you maybe your best deal of the year.
Yeah.
I mean, I don't know. I mean, I'm just thinking about it going, this could be the best deal that you're going to get
Right.
in 2 years.
Interest rates are not going to be a price reduction. They're going to be the opposite. If interest rates go down, there's going to be a price increase. We've seen it. We've lived it.
We know that's going to happen. Right. And look, I'm not going to do the saying, because I'm so sick and tired of saying the saying of, I'm not saying
I don't even say
I'm
it.
not saying it.
Yeah.
I'm not saying it.
I'm like, what works for you?
But here's the deal. Get in.
Yeah.
Interest rates go down.
Right. Guess what?
When things happen.
Yeah.
Refinance it.
Yeah.
And how much does refinancing cost, Paul?
I mean, honestly, when you're not counting the prepaids, which are your taxes and insurance, remove it, because you're just recycling money.
Right.
At that point, $4,000 a pop, $4,000 a pop, right?
And what could that interest rate save you?
Depending on the rate. I mean, I've saved people just as recently as last month, saved them $600 a month, which in 5 months would pay for that.
So you're trading 4,000 for 7,200.
Yeah.
Is what you said?
Yeah.
Is that
that's just 1 year?
I did math pretty quick in my head.
It was 1 year.
But in 1 year, what you just said,
Correct.
$4,000 in 1 year.
Yeah.
Versus I can save you 72, which means that
I have refinanced.
That's a pretty nice return.
But I have refinanced people to higher rates before. Why have I done that? Why would I take somebody and refinance them to a higher rate?
Yeah, why?
Because they've accumulated so much debt in other areas. 2 new car payments, $20,000 in credit card debt, whatever. They had a 3.5% interest rate. They had all of these payments on top of it. I've refinanced them to a higher rate, made all of their debt tax deductible that way. Because, by the way, your car loans, your credit cards, and anything that is not that house is not tax deductible. It is what I refer to crap debt.
Right.
It doesn't do anything for you.
Right.
It makes you pay more money out.
And it stinks.
Every single month.
And it stinks.
Technically, it stinks.
Yeah.
But refinance the house.
At a higher rate.
Cashed them out, paid off all their debt, saved some clients sometimes anywhere between $1,200, $1,500 a month. Made their house payment go up by $600, $700 in the process. Like, oh my God, my house payment's going up by X. Correct. But you're no longer paying $1,500, $1,700, and you're not getting tax deductibility.
That's the thing. You're getting tax deductibility at that point.
Yep.
Which is genius.
Yep.
By the way, genius.
Yeah.
That's absolutely
it's one more added benefit to it. And by the way, your house is increased in value.
Anyway.
It's still going to increase in value as long as you're not maxing yourself out.
Yeah.
What are we doing?
Yeah.
Yeah.
Okay. Here's the thing that we have to address. We have addressed it in the past, but
There's a gorilla in the room.
It's just that
There's an elephant in the room.
It's just that we are so stuck on when everybody is chomping at the bit to see whatever the Fed does on any given day. But they do. I mean, but then the average consumer is always chomping at the bit, going, "What's the Fed going to do? What's the Fed going to do? What's the Fed going to do?" Thinking that, I believe we think this, that there's some immediate effect. What if the
there is?
Well, there is.
There is.
But not in the areas that we think it is.
Right.
So you have repeatedly been on the show. You have been into real estate office after real estate office across the triangle. You've said this over dinners, over lunches with individuals. You have said, if the Fed lowers the rate, watch, mortgage rates are going to increase.
Yeah.
People don't want to believe it.
Every time.
People will go.
Not sometimes.
And even if you don't want to believe it, you'll go, I'm skeptical. Okay, I'll give you that. But typically we get, I don't believe it.
There's chart.
Help.
Research.
Okay, help everybody understand.
Yeah.
When they lower an interest rate, there is an immediate effect, but it's not the mortgage lender effect. It's short term.
STL, short-term lending.
Short-term lending. What? Let's just help everybody out there trying to understand. Fed lowers the rate.
Yeah.
Short-term lending. When we talk about short-term lending, what are those things that fit into short-term lending?
Sure, this is easy. So I will say that something that can affect your home is part of short-term lending. Home equity lines, that's short-term lending. Credit cards are short-term lending. Car loans are short-term lending. Commercial loans, short-term lending. And I am, if anybody knows me, they know I'm a political animal. I mean, I am. It's just part of who I am.
Right.
I totally disagree with the current administration on forcing the Fed to lower short-term lending rates, the Fed, Fed funds rates. I believe that it should be something that's done organically. But I will say, I truly believe that Jerome Powell is lazy compared to Ben Bernanke. At least Ben Bernanke was trying different things. He was doing QE twist. He was buying treasuries. He was buying bonds for that Federal Reserve. So he was being proactive to help lower rates across the board, not just for the STL, short-term lending, but for everybody. Meaning, in other words, he was trying to find a way to save everybody money, and that included homeowners. Okay. Bless the president's heart. And I say that again, with all due respect, but because he comes from a commercial lending background or commercial real estate background.
Commercial real estate background.
Yeah, because his background is commercial real estate. The only thing that he thinks is Fed. It's ingrained in his head.
Sure.
When the Fed lowers rates, I get to refinance my 50 buildings and 50 properties.
Right.
And I can save money on those properties. Right. I get his reasoning.
But from a mortgage standpoint, it just doesn't work that way. In fact, it's just the opposite. You've preached this. The Fed lowers the rate, the interest rates go up.
Every time.
Let's bear with us, okay, out there. Let's explain one more time why, when the Fed lowers the rate, do home mortgage rates increase?
It's still the bond market. It's still the bond market. So in other words,
and I don't think people understand.
Okay.
I don't think people understand. See, okay. So here's the thing. I think when we go, it's the bond market, and they're going. I think there's a bunch of people out there, right, who go, wow,
they don't know what bond.
Well, what's the bond market? I don't even know what the bond. It's. I don't see that on the stock market. Is that somewhere on the stock exchange? Do I? I mean, do I look that up? Is there a symbol for that? What is the bond market?
So treasuries are our national debt. I mean, it's our debt. That's what it is. But people buy it at different rates, and if people sell it at different rates, it's what it is. But understanding how it ties to 30-year fixed mortgages, or how do these things work actually? So there used to be 3 markets. Now there are 4. One is about to be consolidated to the third market. It used to be stocks, bonds, and commodities, right? Now we got stocks, bonds, commodities, and now we have cryptocurrencies.
Right.
However, cryptocurrencies are about to go into commodities. They're
okay. So they're going to be consumed by commodities. They're going
to be regulated as a commodity.
Okay.
Finally, somebody put a face on it. Our federal government has finally put a face on it. Anyway, the point is that the bond market looks at our long-term debt, our long-term financing. It looks at everything that we're doing. And there are bonds, treasuries sold around the world. The British have the Gild. The Germans have the Bund. They are all the same things. They are debt. They're packaged debt.
Why does somebody want to buy that?
Because they get an interest rate return. They get a yield return on that. Exactly. It's like buying they used to sell bonds, $50 bond certificates, right?
Yeah.
There's an interest rate return on that.
Right.
Okay. And when you buy your bond in particular, if you buy your bond at 2% and the economy starts to explode one way or the other, and you can then sell your bonds at 4.5%, you've made a 2.5% return on that at that time. You've made money. Sell
Right.
your bonds at that point, right?
Right.
But to get mortgage rates to come down, there is no magic wand.
Right.
There is no one thing that anybody can do. Well, technically, everybody has to believe in our debt. People have to believe in our treasuries enough to buy our treasuries. Now, again, going around the world, around the entire globe, number one, our treasuries are the safest on the entire planet.
Mm-hmm.
That's why other countries buy it. China has a lot of our debt. Russia has a lot of our debt. UAE has a lot of our debt.
Mm-hmm.
And they buy our bonds. They buy our treasuries.
Which, by the way, ultimately means, when we think about this, that other countries believe in our economy
more than they do others.
more than
their own.
More than their own.
More than their own.
So they're willing to buy our debt.
Yeah, of course. Now, some countries have no debt at all. UAE. I mean,
right. They have zero. Whatever. They don't care.
Yeah.
They don't.
Debt. What's that?
What's that? Yeah, they don't care.
We're building an island.
Right. We're going to take a desert and turn it into grasslands. Right. Yeah.
Whatever.
So, but I mean, I think this is what people need to understand.
Right.
Is that okay? And then we're going to connect this. We're going to connect the dots for you. I promise. We're going to connect the dots.
Lying.
But we have other countries.
Yeah.
That are buying our debt
and U.S. and
believing
entities,
in these and even U.S. entities believing that our economy is going to change and improve.
Going to be the strongest one on the planet. Yeah,
and so that they can sell those to make money
for a profit.
Okay,
every time. That's why
Okay, so by the way, that helps clear it up for everybody. Okay, so now, now hold on here.
Still Greek.
Okay, still for a lot of. Yeah. Okay, but here's the deal. Paul, that's a really neat factoid.
Right.
What does that have to do with my mortgage on my house?
Well, I mean, again, the treasuries are, I mean, your house is debt really at the end of the day. I mean, it might be a commodity to you, but if you have a 30-year fixed mortgage, or if you have any mortgage on it, really, it's still a debt, right? So all debt is technically, it's compacted and it's all tied together. That's a loose way of saying it, by the way. Beside the point. When you realize that your debt, is better than everybody else's debt, when everybody is buying our debt, then our yields decline. And even though our yields decline, our yields are still better than any other guild or bond or anything else. So in other words, when people are buying our debt, they're saying, hey, I can get more money in my rate of return than if I buy British debt or if I buy German debt. All right. You want people to buy our treasuries, our bonds. And again, there's something I want to disagree with on the current administration. They're talking about taking $200 and $250 billion of tariff money that they've made that's put in the treasury right now, and they want to give stimulus checks to everybody. My premise on this is that money needs to go to buy back our debt and lower our treasuries and lower our yields. So
which then would lower the mortgage rates.
Exactly. That's what I think should happen. Right. Instead, they're talking about sending $1,000 stimulus checks to whoever.
Yeah. Right. So here,
I'd rather lower my payment by $600 a month than get one stimmy check for $1,000 because that means I've saved $7,200.
But then the other part of that is if we are able to lower the interest rate, here we go. We don't have to worry about a 50-year mortgage because all of a sudden affordability becomes easier for us to get entry.
Correct.
Right. Because I mean, we do have to admit that first-time home buyers probably at the biggest. Is got the biggest hardship right now.
What is it now? Now somebody wants to buy a house, they're 38,
40
now, 40.
It's 40. So the average first time home buyer age just came out. Shout out Tony Fink who brought those numbers in. 40 years of age.
Yeah, 40
years of age, first time home buyer.
Wow, I was well above the curve on that.
Yeah, you're way above that, right? So the thing is, when people say, oh, the Fed has lowered the rate, you've always said interest rates are going to go up.
And they have every time. Interest rates in September were about 5.75, 5.875 on FHA. Today, after the two Fed cuts, Today they're probably 6 or 6.125. I haven't looked at a rate sheet.
A little less than 6.25.
Yeah, exactly. So in other words, it's higher. And it's not lower, it's higher.
Right.
Right.
That doesn't mean it's not going to go down. I mean, we should.
Oh, no, it will. I mean, again, as long as people buy our treasuries, rates.
Right. As long as the treasuries are being purchased.
By the way, when I say treasuries, I also mean bonds. They're the same things.
Right. So I think for you who are listening and viewing us, by the way, thank you, viewing us here, I think what is important to understand is when you see the Fed lower the rate, expect the mortgage rates to go up immediately. And by the way, it happens every time, right? You'll get this standstill where nothing happens, and all of a sudden that rate goes up a little bit, and then over time it starts to cut itself back down.
It balances back,
and that time seems to be pretty variable,
right?
Because when I looked at it the last time the Fed made their cut, and I got all excited, going, "Oh, the rate's going to go down." I saw them take a dip for a second, and then they jumped up.
Yeah, knee-jerk reaction was the other
way. Because it did drop for just this short. And when I mean short, I'm talking a week, maybe days, that it dropped just a little bit. And then it jumped way up. And not way up, but jumped up a pretty good chunk. And then I was like, oh, wow, here we go. But then they slowly came back down.
Right.
They slowly came back down for a second. And then they hold steady.
Right. So one of the things that people want to look back towards, go back to 2020 during the pandemic. And during that period of time, the Federal Reserve came and said, I'm cutting interest rates down to 0.25%, right? And a lot of people think, oh, well, that was what caused mortgages to decline. No, what caused mortgages to decline during that period of time was the stock market sold off by half.
Right.
It went from 30,000 down to 18,000.
Yeah, right.
Where did that money go? It doesn't disappear. It doesn't go into the ether.
Such a great point.
Yeah.
Such a great point.
Right.
Because the money goes somewhere.
It doesn't disappear. It doesn't evaporate.
It doesn't evaporate. Somebody's got that money, by the way.
Where did it go?
Somebody's got the money.
Right. Where did it go?
I mean, right?
It went from the stock market to the bond market.
Right.
They put that money into the safest haven with the highest rate of return.
Which was the bonds.
Yeah, which they could find. And when people took half of the stock market and bought the bond market at the same time, interest rates went down to 2%. By the way, there's no magic wand behind that.
Right.
That is ones and zeros. That's just what happened.
Right.
When the Fed cut Fed funds rates at that time, again, car rates went to zero. And when you buy a new car, it's a zero rate. Why? Because the short-term lending was low.
Right. See again, and again, this is where we get confused, right? I mean,
we want to take news blurbs
and we get very confused about how this works, because let's be honest, the news is not explaining this. What you just got here, which was a tremendous education, is not being explained to you. Local news, national news, it's not explaining this, because they push a narrative of the Fed lowered the interest rate, and that's all we know.
That's all we hear.
But it's all we know.
Right.
It's
all what they're telling us.
Unless you come to real estate right now,
right,
where
you actually hear how
it works and how it really works.
Right.
So now that we got that understanding, right? This is why it's so difficult when I have asked you or your other colleagues in the lending industry, what do you think interest rates will do? There are so many factors involved with this, the bond market being the major part of it, because I don't know because you don't know what people are going to do with bonds. Are they selling, buying, holding flat? What are they doing?
Right.
And so then it makes the mortgage interest rate very unpredictable and hard for you to go, this is what, now we have expectations, right? We have expectations.
I used to.
Right.
I used to.
But we kind of go, we believe that we should see them drop, but I don't know that we're going to see them drop majorly.
If I think the bottom, and this is just me,
right?
Again, other people can predict whatever they want. I think the bottom, if we see continued oil extraction, continued LNG exploration, if we continue to produce more energy domestically, then I think our bonds, which is tied to energy, by the way, I think our bonds will continue to drop. I think if we look for a bottom, we will probably see it somewhere between 4.5% and 4.25%. And wouldn't you like to be in your house prior to that, knowing that you can refinance and save money on your monthly payment versus being out there at 4.5% and 4.25% and starting the bid wars all over again? Because that's what would happen. And
I think this is where it gets so convoluted for people, because if you're sitting there waiting, right? Like right now, if you're sitting there waiting, thinking that, well, I'm just going to wait until the interest rate is lower, right? Which may be, it could be as many as 5 years from now. Could be. I'm not saying it is. I'm just saying it could be 5 years from now. And you're sitting there waiting. Meanwhile, as housing prices have at least stalled, some have even dropped. Resales in particular have dropped a little bit in certain areas.
There's more value in purchasing a resale than it is a new
construction right now, right?
There's more value.
So if I'm getting in now with an interest rate that I don't necessarily like, but really isn't terrible, if you've been around as long as we have, is not really terrible. And then you go, okay, I'm going to be in this house and I can get a lower interest rate over the course of time, refinance.
Yeah, a couple times, whatever.
A couple times, whatever. Refinance the house and drop the rate. You're in your house.
Yeah.
You're in your house. If you wait, here's what I want you to think about. If you wait till we get to 5, let's just say 5 as a number, how many people are going to be in the market?
Yeah, everybody.
How many people
jumping
in?
And
then do you remember what happened during the pandemic when everybody was in the market?
People were taking money out of 401ks to bid it over on their house.
And how many people, I know because we sold a house.
Yeah.
Our personal house during the pandemic.
Yeah. Good time.
And can I tell you, line of cars waiting to see the home.
I believe it. It was a bargain back then.
On a Monday, on a Tuesday, on a Wednesday, on a Thursday.
How many offers?
30. I can't even remember the number. It was absurd.
Yeah.
It was absurd.
And were they all at asking price where you had the price set?
No, they were above.
Right.
They were above. So now think through this with me, folks out there watching and listening. Think through this for a second. Do you really want to be at a lower interest rate, wait to a lower interest rate and be in so much competition
in the pool
that you're overbidding for the house? Not only that, waive inspections.
Yeah. Due diligence is massive.
Due diligence was huge. Some due diligences we saw in 6 figures.
It was weaponized at that period.
Right. I mean, people were, which by the way, in the state of North Carolina, if you're not from North Carolina, understand that is the money you're willing to lose.
Yeah. You don't get that back.
You don't get it back.
Yeah.
Right. You get your earnest money back, but you don't get your due diligence back.
Right.
So the people who would put 6 figures.
Yeah. Oh, I saw it. I had contracts.
6 figures on due diligence.
Yeah.
Willing to lose it.
Waive inspection.
Waive inspection. I will buy the house as is. Don't care what.
Crumbling infrastructure.
Don't matter. I will buy it as it. They were willing to do that.
Because the rate was also 2%.
Right.
I can afford this house.
Right. So, but here's the thing. Do you really want to be in that kind of competitive market? Or would you rather be at a little bit higher interest rate right now?
Not fighting anybody.
Getting
a deduction on the house. Maybe get some concessions because your inspection came back.
Right. Get some seller concessions that you wouldn't normally get.
Yep.
The opportunity here
it's a buying opportunity
is huge.
Yep.
And I don't think we see it right now.
It's not talked about enough.
But it's not. But because you're looking at end of year, you got a tax deduction.
Yeah.
Right before the end of the year.
Sure. Small one. Yeah.
But you'll get a little bit of one.
Yeah.
right? Certainly next year
Next year is going to be massive.
is going to be massive,
Yeah.
right? And you're in your house.
Yeah. Meanwhile, your neighbors, when rates start to go low and you're refinancing and saving yourself monthly payment money, and rates go low, your neighbors are going to start
Right.
selling their houses, and they're going to sell their houses for X and Y, and it's going to bring up the equity value in your property too. And you're comfortable with it.
See, this is the other part of it. We didn't even get to that. And that is when it does flip.
Oh, yeah.
And then your neighbor's selling your house.
That's right.
And all of a sudden they got multiple offers
Yep.
on their house. What does it do to the value of your property?
It's going up.
The value of your property just went up.
Yep. You're gaining.
All of a sudden you're wealth building.
Other people are making your house increase in value.
And it is the most ethical, legal way to use other people's money.
Even
It really is.
Let's say you purchased that house and you did a 5% down loan and you have mortgage insurance at that time. And let's say rates are stagnant. Well, they've just, still brought up the value of properties around you. Now you at least save money by getting your mortgage insurance waived.
Right.
Like there's always savings possibilities for you. But you can't save while you're sitting on the fence.
Yeah.
Like I said, if you're sitting on the fence, your butt's hurt.
Yeah.
If you've sat on a fence, you understand the reference.
Yeah. I'm from the farm.
Yeah.
I get it. This has been fun.
Yeah.
This has been a lot of fun.
Always.
I mean, we kind of jumped in a little late today. No, it's not his fault. We just jumped in a little late. We did have some technical difficulties before he got here too. Fun. Thank you for coming in.
No, you're welcome, brother.
Tell them how to get a hold of you because you're ready to buy. They're ready to buy a house. They got it.
Ready to buy?
They're ready. They're ready to buy a house. They need
now?
to talk to them. They need to talk to a mortgage lender first. You need to talk to Paul.
Paying your money.
I'm tired of it. You know what? I believe in what you're saying. I got it. Paul, how do I get a hold of you?
You can reach me by phone. Always the best way to get a hold of me. Call me 919-612-0043. It's 919-612-0043. You can also email me at pfitts@advantagelending.com. That's pfitts@advantagelending.com. I'm always happy to be the real mortgage advisor, not just a mortgage salesperson. I do what I can to advise my clients in always the best capacity for them. So feel free to call me, ask me questions. I'm always happy to help you out.
It's awesome.
Yeah.
Stay with us, Paul. Hey, folks, this is show you a lot of choices. You chose us. Thank you for doing so. You know what? Do us a favor. Give us a thumbs up on YouTube. Wherever you listen to the show, give us a 5-star review. Tell your friends. And you know what? He hits something right away there. Share it. Share it. The information is so valuable. Yeah. I know it is because it'll help people who don't understand. And that's what we try to do here in real estate right now. As I say to you all over the world, you know what that is? Ciao, everybody.
Thanks.